Okay, so very good morning. Welcome to a new week, a new quarter as we look to see out this year. And this morning, just sharing with you the first chart we're going to look at this morning is cable. You can see 128.72, that mid-August low, just being tested this morning after we initially managed to break the low that we're seeing kind of mid-September. That 129 handle gave way. A move below here is significant technically, and then 128.06 was going to be the big one to look at. Obviously that is the post-Brexit low, that was the Brexit night, and then the Brexit low comes in there. And there does seem to be a sense of inevitability about this move, whether it happens today. Certainly a 70 or so pip move to the downside to get to a test of that level does not seem unrealistic. So why is this happening this morning specifically? Well, you can thank this lady, being one of her first most kind of authoritative speeches of outlining the timeline for Brexit. She spoke at the start of her party conference and suggested that Article 50, the thing that we've been waiting for such a long time for clarification, because remember it's the triggering of that clause which then will basically then lead us in towards the negotiations for our Brexit. And she said Article 50 will be triggered before the end of March next year. Sky sources have also suggested that civil servants are working on being able to trigger by mid-January. This has certainly spooked the market slightly this morning. Bojo saying February last week. No one really batted an eyelid because no one really listens to what he says anyway, to some extent. But Theresa May coming out, obviously it's from the main person in power. She's outlined it. First time someone's really put a concrete timeline into place, and late March looks like that's when we're going to get it. And that kind of forces the idea then potentially of a hard Brexit, because if you did listen to her speech, she certainly is sticking to her guns in terms of the decision that the country made is final. And this is what we're going to do going forward. And so the pound coming under some significant pressure, I would keep an eye on that for sure today. Just bear with me 1 second. I just need to reshare my link in another room. So I'm just resharing my link so you can see my shared screen. So that's the story of the pound. I would say that's going to be probably one of the things in which the market's going to focus on, particularly today, just given the fact that there's 3 concurrent market holidays today. Well, 2 market holidays. You've got German markets are closed for Unification Day, so the reason why you cannot see any DAX shared on my screen is because the DAX is closed, Eurex trading. Eurostox likewise is closed as only for today. Then overnight in Asia, the Chinese markets are closed all week for Golden Week, so you can anticipate that you'll probably get slightly lighter volumes. And then is Rosh Hashanah today, which is Jewish holiday, will last today and tomorrow predominantly, which will mean that volumes stateside are also going to be impacted. So that's going to be a couple of contemplations for today for trading and this week, because lower volumes does tend to lead to generally quieter markets, but can lead to, if this pound really starts to get its motor on, it can exacerbate the moves if there's generally thinner conditions, and certainly when we're near some of these technically important levels. Just moving on though, the other story, of course, which has dominated the weekend news flow and last week, is that of Deutsche Bank. Looking at the company share price, we kind of phenomenal bounce that we had at the end of last week. Kind of looking where that share price was. We started at around 11.20, got all the way down to sub 10 before then rallying the entire move. So late Friday afternoon, just before the European cash close, just going back through the news feeds, there was obviously a a rumour and reports that came out about Deutsche Bank close to a $5.4 billion settlement with US officials. And although that sounds pretty disastrous as a headline on its own, again, putting this in context, that's far smaller than the 14 billion that originally sent their shares into a tailspin around a week ago. As such, just looking at the stock charts this morning, the S&P, you can see had a strong rally as we went into the European close on Friday, and then ultimately found a bit of resistance up at the levels we were trading. I guess this was Thursday's session, before a bit of profit taking, it looks like, into the close. So Deutsche Bank still definitely a stock to watch as we go through today and the trading week. The latest news flow, discussions with the US Department of Justice are continuing, with no deal yet presented by either side, according to sources in the journal. Several of the company's current and former senior bankers have been charged for colluding to falsify accounts of Monte dei Paschi. And elsewhere, the company's German business leaders offer support to the company, with bosses of BASF, Daimler publicly backing the bank. There's been a lot. I've seen likes of one of the major rating agencies, I think it was Moody's as well this morning, all suggesting that Deutsche can withhandle large litigation fees. So the investment community is certainly looking to get behind the bank, because as the CEO has been saying at the weekend, putting this down to more purely a speculative attacks on the bank rather than anything fundamentally wrong with it. I mean, obviously that could be argued quite strongly when looking at their actual balance sheet, but nonetheless, Deutsche Bank certainly is going to be a stock to keep half an eye on. One interesting point actually I read at the weekend in regards to Deutsche is just looking at the Bund chart here. You can see on my timeline we're really looking at September really as the month. And you can see, first of all, we had, as the markets kind of started to stabilize, US data was coming in, actually yields started to rise and Bunds came off quite considerably from around a 165.5 handle down to 162.50. But then gradually we've kind of reversed all of that move in the latter half of September. Obviously the Fed chose to be more dovish in their dot plot projections, intonating towards a more shallow rate of normalization of interest rates. Coupled that with some nervousness over the Trump situation, and certainly European German yields have once again that inverse relationship with the price have been pressured lower once more, which is really this gain that we've had in Bund futures over the second half of September. Now this does bring about a real problem for the ECB. Some of you might have seen me tweet this over the weekend. But although Deutsche Bank's recovered, and that's good for the moment, obviously Bunds are still sitting up at this, in a monthly basis, elevated levels. And this does create a real problem, because as yields get pushed further into negative territory, this again starts to put pressure on the ECB. Because don't forget, the ECB has a definitive criteria towards the bonds in which they can purchase in regards to a minus 0.4% deposit rate. Any yielding bond beneath that threshold they cannot purchase. So when Bunds start rallying like they do, Deutsche Bank's wobble last week has put $2 trillion worth of bonds beyond the ECB's reach. So ultimately, as you can see here, about a third of euro area sovereign bonds now yield less than the ECB's deposit rate. So this idea we were talking about 5 or 6 weeks ago, about the diminishing universe of bonds in which the ECB can buy, that's going to become, if the Deutsche Bank situation starts to deteriorate further and more market nervousness appears, whether that be politically in the US or for other unknown reasons as yet, certainly the ECB at some point in the future are going to have to tweak that program if they want to continue it, and it to have the meaningful impact that they are after. Another article as well that's probably worth talking about, I've already had 2 people mention it already to me this morning. This is kind of a classic, I would say, trader story that traders always get excited about. But for me, I would take it with a very large pinch of salt. I think it's just statistics, creating statistics to benefit an argument. And you're probably going to see a lot of these as the weeks go by. Don't forget, really, we're only about 4 weeks away from the US election. About a month and a couple of days. So certainly from a macro theme, although we've got to monitor things like Deutsche Bank, I think the OPEC situation is kind of moved on for the time being. We know what the situation is there. Obviously, I'd be vigilant for any updates in towards a potential breaking down of that preliminary agreement that was struck in Algeria. But soon enough, everyone's going to be poll watching again. Looking at bookies odds, obviously we've got the 9th of October, the 19th of October, we've got the next second and third televised debates between Trump and Clinton, but that will be the overriding, dominating macro theme that will drive financial markets. That's granted if the market starts to have some sort of, moves attention away from the nervousness around Deutsche Bank, which, going by Friday's reaction, with this rally that the litigation fee could be less than half as initially feared, then the market may start to move on from that theme. But this article in general, though, is talking about a chart which predicts Trump will win unless the S&P rallies in October. Now, that screams alarm bells if you were to look at these stats just on the face of it, because October is a bad month in terms of the stock market. Historically, the panic of 1907, the crash of 1929, Black Monday 1987, these all occurred in the month of October. So from a statistical point of view, it's generally a weaker month. But what this chart that's been compiled is suggesting is that the S&P 500's price return between July through to October 31st has typically been a reliable indicator of presidential party re-election or replacement. You can see here the red in the brackets signifying a negative for the month of October has then meant essentially that there was a replacement took place in terms of the running of the presidential party. A positive month is then seen as, they get re-elected and you have continuity. The problem being, at the moment, of course, you've got a lot of, let's say, themes in the marketplace, whether it be hard Brexit, whether it be any type of fall down of the OPEC deal, whether it be more concerns if Trump starts to get ahead of the polls, Deutsche Bank, Italian banks, political uncertainty in Italy. You're not short of potential negatives in the marketplace, and if we get a negative October, the chart would suggest, or this data summary, that then Trump will become president. Now, I think that's completely just looking at numbers. I think this sort of article is very sensationalist, but a few of you have mentioned it this morning, so I thought I should point it out nonetheless. Don't forget, the reason why I'm kind of dismissing it to a large degree is because in the primaries, Trump, whenever he spoke live, was terrible, and yet he still came through. So the fact that, statistically, the winner of the first televised debate goes on to win the presidency every time in the last 40 years, well, I think, again, you can scrap that stat as well, because Trump is a case in his own, if you like, in terms of the people, like Middle England, Middle America, just want an alternative, regardless of whether that's Clinton or Trump. They're just unhappy with the general state of play. So I wouldn't go as far to write it off at this point. Okay, quick look at some other news stories of note from the weekend. You had some Chinese data and actually was pretty solid. This is the Kaizen manufacturing PMI at 50.1, slight improvement then on the prior month. It was a third straight month of expansion as output and new orders went up marginally, while new export orders stabilized. So quite positive signals coming out of China now. When central bankers are looking for performance of an economy, really, the three-strike rule, 3 consecutive expansionary readings, is seen as solid, particularly when we're in a period of contraction for such a long time in China. Looking at the NBS manufacturing PMI reading as well, that also is stabilized in expansionary territory. Output and new export orders were also up. But don't forget, Chinese markets closed for the entire week for the Golden Week holidays. Elsewhere, a quick look at the calendar. So for this morning, you've already had a couple of the manufacturing PMI readings, but keep in mind these are September final prints, which is probably why you've had a fairly muted reaction in the marketplace. Just having a quick recap, the Spanish number came in at 52.3, higher than previous 51. The Italian 51, above the expected 50.3, so have been a little bit firmer than expected. And this, of course, does lead us into the UK figure we'll be looking out for at 9:30 this morning. If you look at the previous manufacturing PMI we had out of the UK, this is when we had surprisingly strong UK data bounce, really, after the depressed figure we had immediately after Brexit. This is when everyone was caught by surprise, and this was when, at the time, cable was rallying up to 135, if you remember. Let me just move my charts over. So this was when we were moving up to 135, we had that really awesome print that came in at 53.3 in August, recovering from the 41-month low. It was the best increase, this jump from that July point to August, that we've had in 25 years. So the pressure's on now as to whether the UK can continue that. For me, really, much like many market pundits you probably hear from at the moment, on the likes of Bloomberg TV, CNBC, the worst, I think, is certainly to come, because at this point, we're only at the very first. The gun's not even been shot yet, and already cable is threatening those post-Brexit lows. This is because this is when the real pain might begin for the UK economy, is when these Brexit negotiations truly get underway. So the data today is going to be important, but I feel data then going forward from really October, November, December is going to be the critical take-home on the impact really of Brexit, because then as we start to get in towards the end of March, when Article 50 does get triggered, that will then be the kind of decisive point for the future of sterling. Likewise in the US then, as per every month, or the start of every month, this is the manufacturing PMI day. So we get the same from the US, and the focal point will be the ISM manufacturing. And if you remember, that last print came in at 49.4. That was much worse than expected 52. And if you remember rightly, this was just before we were watching every data point out of the States to see whether it would be viable or not for the likes of the US Federal Reserve to be able to hike rates. But then we had this disaster figure. So we'll see whether or not this is stabilized also. I would say, though, for US data, it still has taken a bit of a back seat. Just that concept of the Fed timeline is now pushed back a few months until December. On the point of the calendar, a quick look for the week. I will send this out when we do the strategy later. So today, very much based around the PMIs. Tuesday, you get UK construction PMI, the regular API, all inventories. You got the RBA, so the Australian interest rate decision as well. Wednesday is then when you get the service PMI, so similar today, but the service sector. You get that from the other countries as well. And then quite a busy day for the US. You've got ADP employment change, trade balance, services PMI, factory orders, all to come. Again, you get the various job indicators ahead of non-farm payrolls, which we'll get on Friday. So quite a busy week in terms of US jobs data. Thursday, German factory orders. That's been a bit of a weak spot for the German economy, so that'll also be one to look at. And then all culminating into the main kind of US figure, non-farms, which will be coming out. And if you remember, non-farms last month was a little bit underwhelming. And certainly that will be closely followed by the market as well. As I mentioned before, just keep in mind it's a German market holiday, so there's no DAX future trade today. It's Rosh Hashanah, which means that volumes in the US afternoon are likely to be lower than normal. That will be the same case for Tuesday as well. And then overnight session, general activity could also be lessened by the fact that China are out for the Golden Week holiday for the entire week. Finally, speaker-wise, there's quite a few Fed speakers as well on the docket. You've got Fed's Lacker Tuesday and Wednesday, Evans on Wednesday, as well as Kashkari. And then quite interestingly, I've just seen that Stanley Fischer is going to speak about an hour or two straight after non-farms comes out. When I start, I don't want to put around conspiracy theories, but when you got the vice chair of the Fed scheduled to speak 1 hour after non-farm payrolls comes out, I'm sure that will create some speculation about potentially what the number could be. Mester also speaking on Friday, as well as George and Brainard. So a lot of Fed speak as well as they try to manage market expectations. Okay, guys, going to leave it at that. I know you've got the rest of the conclusion of these PMIs coming out. You've just had the French manufacturing PMI. It's come in at 49.7, above the expected 49.5. Again, these are final numbers. So in terms of today's session, keep an eye on that pound. Big level here being tested once. We've yet to really consolidate the break of that 72 mid-August low. Any firm break of that will be a big test then for the Brexit lows. What generally starts to happen as well is that when you start to reach a significant technical point like that, is it kind of becomes something which across asset traders will start to focus on. And that almost becomes self-fulfilling then. The level becomes even more important, therefore for potential support. But if a break occurs, then an extension of the move to the downside can often be very aggressive. And what I'm saying is we're trading around 75 pips above that key level at 06. That is not out of the realms of price range from where we're trading at the moment. So definitely keep an eye there, and keep an eye on Deutsche Bank as well for any further updates. Okay guys, enjoy your day and enjoy your trading week. I'll be in the chat room as per normal. So any questions, please do let me know.